S&P 500 amplified. Let's do it. So the S&P 500 is a market cap based stock index, which makes the weightings of its holding a function of how large the company is. There's just the formula for you. But again, all you have to realize is that it's a market cap stock index. So let's go to the next slide. This causes the S&P 500 to be very top heavy. 0.1% of the index makes up almost, they're just talking about the number of stocks, makes up almost 15% of the exposure. The top 5 holdings of the S&P, well, we're only showing you 4 here: Microsoft, Apple, Nvidia, and Amazon make up, in this case, you're talking about 13, 20, almost 25% weighting in the index. So most of the time, the single stock implied volatility is higher than index volatility. Most of the time, single stock implied volatility is higher than index volatility, and that makes total sense. Next slide. But can we take advantage of higher implied volatility on single stocks while also getting some diversification by trading multiple top holdings? Now, you will remember that 2 weeks ago is all it was, on August 5th, we ran into a situation where the volatility of the index went up by 50% and then again by 50%. Friday up 50%, Monday, August 5th up 50%, the preceding Friday up 50%. So we had a situation where index volatility went up significantly more than individual stock volatility. That's why we said almost always. That's why it's not always, it's almost always. In the case here, you can see this is 16 delta strangles, and you can see the difference in the implied volatility levels. Every one is significantly higher than the SPYs, and you can see obviously the credit received. The reason that the SPY has a higher credit than Apple, for example, or Amazon is just because it's a $500 stock as opposed to Amazon's 176, Apple's 220 or something like that. It's just a more expensive underlying. But you can see the volatilities are significantly higher, meaning there's, for a lot of people, it's just a little more interesting. Okay. Interesting in the sense that your credits are bigger. Interesting in the sense that it's got more optionality, more things to do. Let's go next slide. So the study today, we sold 45-day 16 delta strangles in those 4 stocks. 2010 to present, created a portfolio with a 25% weighting to each stock and compared it to 100% SPY strangles. P&L is a percent of the capital requirement, and then managed all trades at 21 days. So all these trades are managed early. Let's go next slide. So all these underlyings were profitable, but creating a combined portfolio replicates profits while reducing risk. So what we did here was we looked at the 21 days, 14 years worth of putting on 16 delta strangles at 45 days. And we just went out and looked at the standard deviation, the average P&L, the success rate. And across the board, we combined everything together. Okay, not bad. All right, all the numbers look pretty good. That's a 16 delta strangle. Just remember, 70% success rate, average P&L, 1.8% of the credit received. All right, with a standard deviation of plus or minus 10. SPY, on the other hand, still beats this portfolio, mimicking its top holdings, even though the average potential return is half of the stock portfolio. So they were just making the case, just to take a look. So the SPY success rate was 79% versus 70% overall. The average P&L was 2% of the credit versus 1.8%. And the standard deviation, which is basically what are your swings, was 30% lower. The only thing that was different was the potential return. The average P&L was actually higher. So with a lower potential return and a higher success rate and a higher average P&L and a lower standard deviation of risk, the SPY actually outperformed all the other stocks. Now, it's not as easy. This is not as easy as it looks, because the reality of this is we do things only in periods of high implied volatility. So we probably overstated the SPY and understated the individual stocks, which we wouldn't trade when their implied volatility ranks were low. But we had to give you a study, so it's just trying to reinforce that you're not disadvantaging yourself when you're opting out for a lower volatility SPY. Just wanted you to recognize the difference. They're much closer in personality than you think.
Understood.
It's a good study. So some of the takeaways: we trade single stocks when their IV rank is high or the opportunity looks more attractive than the broad market indices like SPY. That's exactly right. Like Apple, when the IV rank is super low, isn't that attractive. It's hard to make money. When the IV rank is 100, it's a lot easier to make money there than it is in the SPY. However,
Sure.
SPY is better for consistent returns due to its greater diversification and less frequent large losses. If you're taking IB rank out of the equation, yes, the SPY normalizes everything much more efficiently. When you throw it back in there, you can still pick and choose. It's just not dramatically different on any level.